little bit of housekeeping as we wait for this to go live on our various social media channels. If you are joining us live here on Zoom, feel free to post any questions that you have in the Q&A, and we'll do our best to answer as we go throughout the webinar. If you are joining us on any of our various social media channels, we encourage you to comment, like, subscribe, and if you have questions throughout the session, you can just post your question below, and one of my colleagues will relay those questions over to us live here in the Zoom so that we can get your questions answered in the live session. Of course, if we happen to miss any, we'll go back through all the comments and respond accordingly. So today's session is on audit proofing your business for 2026 and how to protect your business. My name is Andrew Wall. I'm the managing partner here at CPA for IT. And our mission here is to help you organize your finances, create wealth, and transform wealth into a legacy. To that end, a big part of protecting your net worth is being prepared for an audit. And an audit is not something that I want you to be afraid of, but it is something I want you to be prepared for. And in today's session, we're going to talk about the reverse onus, top audit triggers for an audit, what to expect in the audit process, how to prepare for an audit, and warning signs that maybe the audit is going off the rails, and of course, damage control that you can do if it feels like it's going off the rails, and finally, closing up with some information on what to do beyond the actual audit itself. So let's start by talking about the reverse onus. So unlike court, where you're innocent until proven guilty, CRA's assumptions are presumed correct, and the taxpayer has to disprove the accuracy of any of CRA's assumptions. So the onus only shifts to CRA having to prove it in very limited situations. So this requires you as the taxpayer to be more proactive in your documentation. And there's little accountability for the decisions that's made by the CRA auditors if the taxpayer themselves hasn't been diligent in preparing the information. Now, of course, you do have some steps that you can go through in the appeals, and we will talk through that in greater length. But I'm sure one of the big things that everyone wants to know about are what are the top audit triggers? What are the things that are going to make me stand out and potentially be a red flag for a CRA audit? So, of course, there are routine audits that do happen to regular filers and sometimes new filers as well. Now, there's not much you can do about a routine audit, and these is just sort of luck of the draw. But the good news is that all audits only account for about 1% of the population. That's all GST, HST, payroll, corporate tax, personal service business. All audits only happen about 1% to about 1% of business owners. So again, it's not something that you need to be afraid of, but it is something that you should be prepared for. And in fact, if you're not prepared for an audit, that means you haven't done the right job in getting your books organized in a way that has maximized your deductions. And I know that there are some people that are afraid to take certain deductions because it might trigger an audit. And what I would say is that if you have your expenses documented properly and you've got your books in order, that you shouldn't be afraid to trigger an audit because you are above average in an individual expense category. Because of course, that can trigger an audit. CRA does run a benchmarking analysis similar to the one that we prepare for you. They don't use ours, obviously, but they do use that as a tool to identify situations where you're significantly out of variance from industry standards, as well as over year variations. Now, many people will assume that that means that they should just use the same numbers every year, but I can tell you that that can be just as much of an audit trigger as wide, huge variances. CRA does expect that there will be ebbs and flows in the cycle of your business, and that if there aren't ebbs and flows, that in and of itself can be a trigger. So unusual activity, unusual deductions, as well as unusually standard like unusually similar deductions can be just as equally painful when it comes to the red flags. The other thing that can cause an audit is if you have expense claims by employees. And the reason that this happens is because CRA is worried that you're double dipping, and so they're going to want to take a closer look. Of course, it doesn't mean that employees are not allowed to claim expenses, but back in the day, before they before they changed all the penalties with late filings for T4s, when people were routinely late, we'd often do a consulting fee, but we're very clear, don't claim expenses against the consulting fees because that will trigger an audit. We don't often use consulting fees anymore as a strategy because of GST, HST risks. And now the penalty for late filing on a T4 is only $100. So we tend to avoid that strategy. But if you do have employees who are claiming business-related expenses against either consulting or even employment income on a T2200, that does elevate your risk for an audit. Doesn't mean you will be audited, but it does elevate the risk. The other things that can elevate risks are things like recurring losses. Now, it doesn't mean you can't have a loss, and typically CRA will allow you to have 3 years of losses before they will look into whether you need to be audited or assessed. But beyond 3 years, first of all, you're not able to claim losses back more than 3 years. So at that point, the losses are just carrying forward to be applied against future revenues. So it's not that beneficial. But in addition, after about 3 years, CRA is going to want to know that there is a realistic chance for profit in the future. So that can be another audit trigger. The other thing is requests for amendments or appeals. Effectively, every time that you are submitting a file to CRA, you are increasing your probability. So that means if you're doing an amendment, you're resubmitting your information, so you're increasing your probability of being audited. It doesn't mean that you shouldn't do amendments and you shouldn't make changes when and where appropriate, but it does elevate your risk for an audit. Of course, there can be complaints, whether those be worker complaints, EI complaints. We've seen more and more class action lawsuits with independent contractors versus employment. That can trigger it. PSB can trigger it. Of course, demographic discrepancies, like you are significantly out of variance, as we said earlier, with not only your industry benchmarks, but the Joneses. We have seen audits where CRA has used information provided by third parties like Home Depot, and they did a big run against tradesmen, and they could correlate the information from Home Depot against what was being reported in the businesses to find discrepancies there. CRA initiatives. There was a CRA initiative against personal service businesses a couple years back now, which in and of itself could trigger a PSB audit as well as a general audit. Third-party information. There are LEADS programs. There's the offshore tax informant program. There's the Panama Papers. There's a number of different ways that people can report your business that could trigger an audit through that process. Of course, failure to provide information, whether that's a filing or information that's been requested, can inevitably result in an audit. And then lastly, any insolvency proceedings. So if you are going through a bankruptcy or anything along those lines, there is a high probability for an audit for those years as well. So just be aware of that. Now that you understand what could cause an audit, let's walk through what to expect in an actual audit, because not all of these audits are created equal. And obviously that reverse onus informs every aspect of the audit dynamic. And most audits tend to go off the rails when the auditor basically is misinformed or misinterpreting information or confused by the information confused or suspicious of the information that you are providing. So the most important thing in an audit is understanding that anything that CRA requests is effectively you are required to provide. And that negative inferences can be drawn when you don't provide that information or you provide incomplete information. So it's really important to make sure that you're maintaining proper records, that you can go back and provide this information quickly and easily so that you're not spending a lot of time, burning your wheels collecting the information, as well as so that you can respond in a timely fashion to the CRA's request for information. Now, what I do say is the first request for information is often a generic request for information asking for a ton of documents that, if the auditor does truly require this, you are obligated to provide them. But oftentimes that's a generic message. And if you pick up the phone and speak with your auditor to understand what they're looking at, what they're looking into, what their concerns are, you can substantially reduce the amount of information that you have to provide, which will reduce the amount of time that you spend gathering that information, but also reduce your risk, because you don't want to provide more information than is necessary and open doors to other rooms that you weren't hoping CRA was going to take a look at unless they're specifically interested in looking at that room. So using an electronic file management system is strongly encouraged. We do provide for all of our clients access to Lisio, which is a document management portal where all of your documents are searchable and retrievable. And it's really important to make sure that you maintain and keep those records, whether you're a client with us or on your own. And I always strongly encourage people to keep their own separate record as well. Obviously, our information is kept up to date, but if you ever leave us or, God forbid, we were struck by lightning and, something happened to our business, you want to make sure that you have a copy of those records accessible easily and in a timely fashion. So typically they're going to ask for a bunch of information. If you can get on the phone with your auditor, oftentimes it's very easy to request an extension. Sometimes you don't get the notification until several weeks after the audit was initially triggered. CRA is very willing to provide extensions, but it is important, like I said, to get on the phone and speak with your auditor to understand their concerns. Doesn't mean you need to provide any information in that initial call, but gather information from them, understand what they're looking for, be helpful and assistance. This does not need to be a combative situation. Most auditors, believe it or not, are actually very junior level. It's only their supervisors that are a little bit more senior and experienced. So often they're not even sure what they're looking for. They're just, have been tasked with drilling into a specific question or issue that has typically come out of maybe a misalignment between payroll remittances and payroll returns, or GST versus the calculated amount. There's a number of reasons that it might have been triggered, but often they're looking to answer a very specific question. And if you can understand what that question is, it can make your process substantially easier. So in preparing for an audit, the starting point is to, as I said, understand that if CRA asks for information, they are generally entitled to it. But by picking up the phone and understanding what their concerns are, you can substantially mitigate the amount of information you need to provide. But records and books of accounts sufficient to enable the taxes payable or taxes required to be deducted and withheld need to be maintained. And this is an important part of the Income Tax Act. That wording comes right out of Section 230 of the Income Tax Act. And Section 231, the following section, says that CRA has a right to inspect records of any person for any purpose related to the administration or enforcement of the Act. So you're required to keep these books of accounts, and they are allowed to inspect them for any purpose or any reason whatsoever. So what that means is you need to keep receipts, invoices, banking documents, logs and appointment books for things like auto mileage, which is a highly scrutinized account, your accountant's working papers, director shareholders' minutes and resolutions, payroll records, any notes or memos related to decisions that were made, any electronically stored material, tax accrual working papers, all those things that you might have related to depreciation. And depreciation is an interesting one because oftentimes we might have documents that we need to keep beyond the standard, 7-year retention period you might have heard because they relate to a purchase of an asset that is going to be continued to be depreciated for several years beyond that 7-year life cycle. So make sure that you obtain and retain the records that are needed to document your revenue and expenses. You do have to retain records related to inactive corporations as well. So if you are dissolving, don't think that that means you get out of jail for free. CRA can still audit you for up to 3 years from the notice of from the dissolution date. In addition, if they can prove fraud, they can go back up to 7 years from that dissolution date. So make sure you keep those records for inactive corporations, for holding companies, for trusts, for GST, HST returns, all of it. And this must be, the information must be stored in a legible and accessible format. So legible and reproducible is the key thing. So it is rare to be able to get out of jail with a, the dog ate my homework type of answer. But there are reasons that you could not have access to information. We have seen fires and floods as being valid reasons. But with that, you're going to need to have a police report and an insurance report proving that this did take place, because we did have one situation where a client's documents were destroyed in a home fire. They were able to prove that and go forward with some documentation that we were able to gather from banks and information, but without original receipts, and still maintain their deductions. So keep in mind that you are required to keep individual receipts for your expense deductions. And that's, a credit card and a bank statement are great for doing bookkeeping and data entry, but that's not considered valid documentation from an audit perspective, because the receipt shows a number of pieces of information that are not available on a credit card receipt. They're going to show the tax account information for the supplier, GST, HST. They're going to show line item detail of the items that you bought. You imagine you go into Esso, and at Esso, I might have bought gas. I might have been buying cigarettes. I might have been buying candy and pop. So that line item detail helps the auditors make sure that what you're claiming aligns with the actual expense receipt that you have. So you're going to have the tax account information. You're going to have line item detail. And that's the information that's required to have on a valid source document in order for you to claim that deduction. As I said earlier, there are exceptions to those rules, but be very careful with those exceptions, because just because it was accepted in one past case does not mean they're obligated to accept it for your situation as well. So keep those records. They are supposed to be kept here in Canada, but there is some flexibility on this requirement as long as you can reproduce the information here in Canada, which is kind of silly. But so if you're worried about Amazon web servers and stuff like that, you can use that information as long as during an audit, you can access all that information from within Canada. So typically, there's a 6-year retention period. I know a lot of people hear 7 years a lot, but the reality is it's not even 6 years in practice, because after 6 years from the end of the date of the notice of assessment of the last taxation year to the date in which the records relate. And again, this comes back to things like assets that might last multiple years beyond that 6-year cycle. So you'll need to keep those records even if they're well below 6 years. However, again, it's important to know and understand that there is a criteria. After 3 years, that reverse onus that we talk about does switch, and it does become CRA's responsibility to prove fraud in order to go beyond the 3-year statute of limitation. So we do still tell everyone use the 6-year period because they can go back 6 years if they can prove fraud, but that is very difficult and very rarely done. So typically what you see in an audit is almost always a 3-year reassessment. And they want to look at, they'll typically wait 3 years till you've been in business 3 years, even if they're suspicious, because they want to look at all 3 years and hit you for everything that they can. So again, those long-term purchases, you want to make sure you keep records of those memos and notes of things like travel and lunches and meals and promotion and those types of things. You want to keep those memos and that documentation if you ever need to do it. Any sales, liquidations, or windup of businesses, again, you want to keep those records for 6 years after windup. Probably after 3 years, you are likely safe, but you do want to keep them for up to 6 years. Now, in preparing for an audit, there are some documents that are advisable to purge, but I am very hesitant to talk about this subject because often the biggest issue is people have purged documents they shouldn't have rather than purging documents they should have. But let's have a quick conversation about documents that can be purged. So those would be things that are redundant documents where you have multiple copies or multiple emails and memos. You can certainly delete those. Any privileged or confidential material, again, if you have it in multiple formats and it's not related to a specific deduction, safe to purge that. Any drafts that don't reflect the final product, purchase, or sale can be deleted, as well as any papers that you also have an electronic form for. So people wonder, can I scan and delete the documents? Yes, as long as it's legible and reproducible, you can delete the original document, or you can destroy the original documents if you do have a digital copy. Now, as far as things that you should keep is any memos reflecting reasons for entering into transactions. So that sort of preserves the institutional memory. Items related to any issues under objection or appeal, handwritten notes or material that might be relevant to decisions that were made, and of course, invoices, receipts, and documentation related to the revenue and expenses related to the business. Now, there are some great tools out there, and in fact, this session we used to talk about audit proofing using a tool called Receipt Bank, or DEXT, as it's now called. There's a number of tools similar to DEXT. We do love that as a tool because it makes it really easy for you to capture the receipts and then to OCR that information and be able to search and retrieve that information very quickly and very easily. That is becoming accessible with even tools like ChatGPT or building your own custom tools to be able to track and keep these records in a way that is easily retrievable. And that is the most important and largest benefit of a tool like Receipt Bank, is that if you do go through an audit and you are asked for the 10 largest receipts for automobile expense or 10 largest receipts for advertising expense, that you can, for a given period, you can pull that information quickly and easily so you're not spending a lot of time, and you can provide that information in a meaningful format to the auditor so that the auditor can process and move through this audit as quickly as possible as well. Now, there are some signs when an audit is going off the rails, and these are the things I want you to keep an eye out for if you are ever, unfortunately in the process of an audit. So if there's any signs of confusion or questions that seem to feel like they're coming out of left field that seem unrelated to the other information that you've requested or that has been requested, that's usually a pretty good sign that your audit has gone off the rails and they're now looking to dig deeper. And what you want to do, the best thing you can do is get on the phone. Email is great for asynchronous communication, but it can also cause miscommunication and misunderstandings. And whenever you see any signs of confusion or skepticism or honing in on any one particular area of issue or credibility, you want to pick up the phone, or ideally not have your accountant pick up the phone, have a conversation, get the audit back on track and make sure that it stays focused on the original objectives. So if there's also any fixation on what feel like irrelevant details or documents, we've seen that come up on more than one occasion. Um, and they're asking for information that we don't understand why they want it. We pick up the phone, and we find out that there's just complete confusion because the auditor is junior, or they're off on a tangent, or completely misunderstand the client's situation. So often a phone call can alleviate a lot of those concerns, provide the information that the auditor is looking for, without having to, extend or delay the actual audit process. The other concern is when they're the opposite. They're not engaged. So they're not responding to comments. They're not responding to communication. It feels like it's gone into purgatory. And I know sometimes people are like, "Oh, great, they're not following up with me. Let a sleeping horse lie," so to speak. And I would say more often that turns into a bigger issue rather than a benefit, because they don't typically. It's not impossible for an audit to just fall off the table and just never re-engage again. And we did see that through particularly COVID times, where a number of audits ended up just ultimately being dropped. But it's very rare for that to happen. It's usually maybe someone's gone on a holiday or a break, and then they come back and they never reassigned it, and then they pick it up and they're starting from scratch, and you feel like you're going through all the same things over and over again. So that can be a danger that it's, again, going off the rails. And again, related to that, it would be unexplained gaps in time between meetings or requests for information or notice of reassessments or anything along those lines. Whenever you see large gaps in communication. Now, you understand what we have to keep in mind is that with CRA, large gaps are not the same thing as large gaps in communication with typical business people, because CRA takes longer than most people to respond. But if you're not getting any feedback in 4 to 6 weeks, something's gone awry, and it's worth picking up the phone to understand what you can do to bring things back online. So if you need to bring things back online, what should you be doing? So first and foremost is bring in reinforcements. All too often, people feel like they can or need to handle this on their own. It's just a simple question. I'll get it resolved. And I cannot count the amount of times that clients have picked up the phone with CRA, told them information. We're dealing with an audit right now where the client gave the auditor information that has now triggered a much deeper general audit. Client didn't really understand what they were saying, and the auditor interpreted it to mean one thing, which brought up a whole another slew of issues. So make sure that you're working with knowledgeable professionals. So a CPA who knows and understands the issue you're facing, whether that be a PSP audit or whether that be an HST audit or payroll audit or a general corporate tax audit. Also insist on setting the agenda. Don't let them set the agenda. I think back to a lot of the PSB work we were doing. And I remember being on a call where the auditor tried to tell me I had to answer the answer to their questions on the call. I'm like, no, I won't be doing that. You'll provide me the list of questions. I will take those questions. I will draft responses, and I will submit them through the portal. They ultimately had to accept that because it's perfectly reasonable to do. So you can certainly push back on auditors, but knowing and understanding when and where to push back is critical. And that's why working with people who have been through this process before is absolutely critical, because you can push the auditor and you can push them for around process. You can push them around the information that they're looking to identify. You can push them around timelines, but knowing how, when, and why to push is absolutely critical to this process. And that is as much an art form as it is a science. And I can certainly give you tips and tricks, but there's nothing better than having the experience and going through it hundreds or thousands of times like we have to understand that. It's also helpful to write letters summarizing information or documents provided. If If you are going to just send information, a letter outlining the information you're providing and summarizing what you're providing and why you're providing it can go a long way. If you ever get into a situation where you're in a stalemate, where the CRA has one perspective, you have a different perspective that misaligns, there's no point in, again, beating a dead horse here. Let's disengage, save your energy for the objection process. You do have an objection. Once you receive their reassessment, you can object to that within 90 days. And you can go through the notice of objection process. You can go through the appeals process. You do have 3 levels of appeals within CRA themselves before it ever goes to tax court. And beyond that, you can even go to tax court if you disagree with their assessment. And one of the most important things that I've learned as an accountant is that what CRA says is not gospel. CRA is interpreting the Income Tax Act just like your accountant, is interpreting the Income Tax Act. And we assume that because they're a federal organization, that what they say goes, but that's not how it actually works. The way it works is they take an interpretation, they can make assessments. If you disagree with that assessment, you have the ability to challenge that within the appeals process within CRA themselves. Beyond that, you have the ability to take that to court. And you have tax court, Federal Court of Appeals, and Supreme Court of Canada that you can go through. Now, I wouldn't recommend doing that unless you're very, very confident in your process. And of course, you would need to bring in a tax lawyer to go through that process. But it's important to know and understand that it's judges who make the laws, and ultimately the determination of any assessments done by CRA, and that you do have the ability to challenge it within CRA, and you do have the ability to challenge it outside of CRA as well if you still do not agree with CRA's process. Now, let's say that the audit is completed, and you disagree with the reassessment that has been triggered. You can file a notice of objection, as we've noted before. You have 90 days to file a notice of objection. And the file is then assigned to the appeals division. In theory, this is an opportunity for a fresh new look and a fresh new set of eyes. In practice, though, it's rare that the appeals will vary or vacate the reassessment without, some additional information or someone who better understands the situation stepping in. And whether that's your accountant or a supervisor, you're unlikely to get a new verdict because there's sort of that institutional inertia that has the tendency to want to support prior decisions. But it can happen, especially if there was additional information provided that changes the perspective, or if in the appeals process you can get through to a supervisor who better understands the situation, and maybe the junior was misinformed and you can help them to see how that junior was misinformed, and how you can clear that up. So it is certainly possible to get reassessments overturned and appealed. But I want to stress that bureaucratic inertia is difficult to overcome. And if you're going to go through the appeals process, you want to make sure that you've got some strong documentation that either was not provided or was overlooked in that initial audit. What else do we have here? I guess that's really just about everything. I don't know if we've had any questions. Let me go back to Zoom for a second to see if any questions have come up here. No questions yet. Do appreciate everyone coming out and joining us for this session. We do have some time left. So if you have any questions or if you have any other general tax questions, feel free to post those here and I'll be happy to go through those with you. Of course, if you don't have any questions, that means As Rachel and I always say, I've either done an amazing job or a terrible job. And I hope it's an amazing job and that you found this session useful. We are looking forward to our next session as well, which is going to be in 2 weeks' time. And I'm going to tell you what it is in just 1 second. So on Tuesday, May 5th, will be our session on stop making these corporate tax filing mistakes. So again, we love to hear feedback. If you don't have any questions, but you do have comments or suggestions on future sessions that we could host, we would love to hear them. Otherwise, again, thank you for your time, and I wish you a happy Tuesday. Bye for now. Oh, wait. I think I see questions. Yay, they're coming in. Okay. Thank you, Andrew. From what I understood, audits are mostly about deductions. Is it correct, or could it be anything else? It could be anything else. And I would say deductions probably the least common. I mean, with the exception of automobile expenses, often audits are triggered by revenue. Underreported or incorrectly reported revenue. HST exempt revenue is a common one. Whenever CRA is refunding GST, HST, like imagine you have exempt income or not exempt, zero rated HST income. You're working with a client in the US and you're not charging them GST, HST because it's a zero rated service, but you're still claiming input tax credits on the GST that you're spending up here in Canada. And as a result, you're getting a refund. Almost always that tends to trigger a GST, HST payroll or GST, HST audit. That's a common one. Payroll audits are also very, very common. So whenever you get misalignments between payroll remittances and T4s, or lack of remittances, those can trigger payroll audits. The most common thing that they're going to do in every audit is ask you for the 10 largest receipts of let's call them high risk categories. Things like automobile, advertising, business promotion, those types of categories that can often be gray between sort of personal and business. So I would say it's not actually generally from deductions. I would say less often from deductions, but while they're going in it's been triggered from another thing, they're going to ask you about your deductions as well. Because that's where they often, get the best savings because people haven't kept the records to be able to defend the deductions that they've kept. And they know that, particularly automobile expense. And I will say this over and over and over again. Keep your mileage log, people. There's technology that makes it really easy to do now. And CRA almost always wins their audits of automobile expenses because our clients are not keeping records of their automobile logs. Okay, so looks like the nice comment, amazing job, thank you. Sam asks, are there certain industries or business models currently getting more attention? Well, as we mentioned, there's often special projects. Personal service business is one of them. Thankfully, with all the work that we have been doing through the NACCB, advocating for the independent contractor market and some new exemptions that we're seeing in ESA for IT contractors, that's becoming less and less of an issue. We are seeing it in truckers. Truckers are big audit risk these days, from personal service business, as far as deductible expenses, as far as GST, HSTs, payroll, you name it. Truckers would be a high risk category for me right now, from what I'd say. At what point do I bring in a professional to help during an audit? I'm biased, but I would say day one. Like, don't pick up the phone and talk to the auditor. Let your accountant do that. If they insist on speaking to you, that should not be done with your accountant there. I mean, just like you wouldn't walk into court without a lawyer, you shouldn't walk into a meeting with CRA without an accountant. And that's, again, I do acknowledge that comes from a biased perspective. But I have seen so many situations where clients think that they're saving a few bucks by picking up the phone and dealing with the audit themselves. And it's often penny wise and pound foolish, and hurts them far more than getting a professional, costs them far more than getting a professional involved from day one. And of course, if you are a client of ours, and you're on under our prepayment package, which is like 90% of our clients, you've got audit representation protection included, which means that we will do all of that for you, and there will be no additional charge for the time that we spend as long as you've got that audit representation protection included. Awesome. I think we have hit all of the questions. Again, I want to thank everyone for taking time out of your day to join us. And I do, again, humbly request for any feedback on sessions you'd like to see. Of course, if anyone wants to ask any generic questions or has any other things, I do have a bit of time for my next meeting, so happy to answer any further questions. I'll give it about another 1 minute or so, and then I will call it a day. Maybe closer to 30 seconds. Oh, we got one. Very informative. Okay, thank you. I'm glad you enjoyed it. Okay, I'm going to call it a wrap there. Thank you again. See everyone next Tuesday. And we'll go through some of the pitfalls to avoid with corporate tax filing. Bye for now.